Listen, if you've been watching silver like it's some kind of sideshow, I need you to snap out of it right now. Because while the internet fights over hot takes and ego trades, something far more serious has been unfolding in plain sight. A historic squeeze on a real-world metal that factories actually need. A metal that can't be conjured by a keystroke. And a metal a whole lot of people are being coached to bet against at the worst possible moment. A quick favor. I'm running a campaign to eliminate copycat channels. If you value what we do here, hit subscribe and comment our John AG so the algorithm knows who the real ones are. Now here's why I'm coming in hot. For roughly 2 months, silver has been ripping higher in a way that's been both thrilling and dangerous, because the price action is not the main story. The main story is what people are being told about the move and what they're being talked into doing because of it. You've got a wave of folks treating this like a casino hand. They're convinced the only smart play is to short it because it's gone up too much. That is not analysis. That is a slogan, and slogans don't pay margin calls. Meanwhile, the people who actually need silver, the manufacturers, the industrial buyers, the supply chain guys, don't care about your chart pattern. They care about deliveries. They care about inventory. They care about whether the metal shows up when it's supposed to, and that's where the real stress is building. Let me give you the timeline in a way that actually makes sense. Not long ago, silver was trading in the neighborhood of $60 an ounce. Then it ran hard into triple digits, and it's been hovering north of 100 while volatility keeps trying to shake weak hands out of the trade. Gold has been moving too, and the whole complex feels like it's trying to reset people's understanding of what normal even is. But I'm telling you, if you're only staring at the price, you're missing the trapdoor, because the trapdoor is sitting under the paper market. And the moment that trapdoor opens, a lot of people who thought they were being clever are going to learn what unlimited risk really means. So today, I want to walk you through 3 things in the exact order you need to understand them. First, the sudden rule changes and margin shifts in futures, and why this time the motive isn't what most people think. Second, the overseas supply chain choke points that are quietly turning a price story into a where's the metal story. Third, the misinformation loop that's luring regular people into the most lopsided trade in finance, shorting a runaway commodity in a physical shortage. And I'm going to tie it all together with one simple question you need to answer for yourself. Are you trying to trade this, or are you trying to survive what comes next? Before we go any further, one quick note for the people who are actually winning right now. If you're successful, share your success story in the comments so others can stay motivated. That matters more than you think. All right. Let's start with the part everyone is getting wrong, the margins. If you've been around markets long enough, you've seen exchanges change rules during a frenzy. Most people have the same mental movie. The exchange hikes margins to cool the rally, protect the big players, and slam the door on the little guy. That's the script everyone expects. But here's the twist. What's happening now looks less like the exchange trying to kill the rally, and more like the exchange trying to keep itself from becoming the headline, because a futures exchange is not a magic wand. It's a clearing machine, and that machine works only if the collateral is there, and the deliveries can be handled without the whole system flashing red. From recent market updates, inventories tied to approved warehouses have been sliding, and deliverable stock has been one of the pressure points people keep circling. Now, I'm not here to drown you in warehouse spreadsheets. I'm here to tell you why this matters. Futures contracts are promises. A lot of those promises never become metal. They get rolled, they get closed, they get netted. That's how paper markets work. But when a rising percentage of longs start acting like they actually want the thing, the game changes. Because then the question becomes, how many paper promises are stacked on top of each ounce that can really be delivered? And when that ratio gets ugly, the exchange has a problem, not just the shorts. This is where the margin math becomes the story. Instead of treating margin like a static number you can budget once and forget, the exchange can shift to a structure that scales with price. That sounds boring until you realize what it does to a short. If you're short and the price rises, you're losing money. Everybody understands that part. But now, if margin requirements scale with the notional value, then as price rises, you also have to post more collateral while you're already bleeding. That's a double squeeze. It doesn't just hurt, it forces decisions. And that's why the just hike margin to 100% crowd doesn't understand the mechanism. The exchange doesn't need a dramatic headline move if it can make the system self-tighten every day, intraday, end of day like a ratchet. So what do you think happens to a short position that was comfortable at lower prices, built with leverage, maybe layered across multiple venues, when the price keeps climbing and the collateral demands keep scaling. At some point, the short has to either add cash or close, and that closing is buying and buying is fuel. Now, here's the part I need you to hold in your mind because it's the first cliffhanger. If margin rolls are now designed to automatically pressure leverage shorts as price rises, then every spike isn't just a spike, it's a stress test. And every stress test breaks something eventually. And this is where you need to understand who the exchange is actually protecting. Decades ago, many exchanges were basically clubs. Members owned seats, and the biggest members had outsized influence. Today, many of these venues operate like public businesses with shareholders, regulators, reputations, and a clearinghouse that must survive the storm. When things get disorderly, they don't just worry about one bank or one trader, they worry about the integrity of the whole clearing process. Here's the uncomfortable math most people avoid. Total warehouse stock is not the same thing as deliverable stock. A big chunk of metal can sit in a warehouse as eligible inventory, meaning it meets specs, but it isn't necessarily posted for delivery against futures. Registered is the part that can actually be used to settle contracts. When registered inventory shrinks, the paper market is leaning on a smaller and smaller real-world backstop. They raise margins to keep the pipes from bursting. And here's your next cliffhanger. If the exchange is worried about the pipes, what do you think the industrial buyers are worried about? Because industrial buyers don't get bailed out by a margin change. They don't get cash settlement as a victory. They need metal, and they need it on time. That's why the most telling signal isn't the price spike. It's the behavior around delivery months. When deliveries look heavier than normal in months that historically aren't the big ones, that's not a meme. That's urgency. And urgency is contagious. Now you might be thinking, okay, fine, that's futures plumbing. But isn't this just speculators? No. And if you believe it's just speculators, you're already stepping into the trap because the demand doesn't look like a bunch of bored day traders deciding to worship a shiny metal for a weekend. It looks like people who need delivery. It looks like a supply chain trying to secure inventory in a world where inventory is not guaranteed. And that takes us to the second thing, the overseas choke points. Let me connect this to something almost nobody wants to connect it to, the energy transition and the electronics boom. Based on recently published numbers about global solar growth, the world commissioned well over 600 gigawatts of new solar capacity last year, and total installed solar capacity pushed past 2 terawatts. That's not a talking point. That's a tidal wave of hardware, and silver is woven into that hardware, especially in conductive pastes and electrical contacts. Even when manufacturers reduce the amount per panel, the total number of panels can rise so fast that overall demand still climbs. And it's not just solar. Everything that moves data, switches power, or demands reliability leans on materials that conduct well and resist corrosion. That's why silver keeps showing up in conversations about strategic supply chains. Now, here's where the China angle gets misunderstood. People hear China and think only about mining, but a huge portion of the world's refining and processing capacity sits in Asia, and supply chains built over decades don't relocate in a quarter. When export controls, licensing, or prioritization get introduced, whether for silver or for adjacent critical materials, the whole global flow gets slower and tighter. And that's why a single headline about restrictions won't matter can be dangerously wrong. The physical market doesn't need a total ban to feel pain. It only needs delays, paperwork, and prioritization. Because delays are shortages when you're running a just-in-time system. So if you're sitting there wondering why the spread between regions can widen, why premiums can persist, why certain bars feel like they vanish, it's because supply chain friction is now part of the price. And this is the part that should keep you watching. When a metal becomes strategically framed, the market stops being purely economic. It becomes political. And political markets don't resolve gently. A lot of people only think about mining. Who digs it out of the ground? That's step one. But the metal that gets dug out isn't the metal a chip maker uses. It has to be processed, refined, shipped, fabricated. That chain is not infinitely flexible. And here's a fact that should make your stomach drop. Most silver is not mined because somebody woke up and said, let's mine silver. It's mined because somebody was mining something else. Copper, lead, zinc, and silver came along for the ride. That means if the silver market screams more supply, the industry can't just flip a switch and respond. Even if the price doubles, the byproduct nature makes supply slow. Mines don't re-engineer overnight. Permits don't appear overnight. Refineries don't expand overnight. And when the bottleneck is refining capacity, not just raw ore, The leverage shifts toward whoever controls the refining and the export flow. Based on the latest publicly available filings and policy updates, silver has even been pulled into the strategic materials conversation in the United States, with silver showing up on a federal critical minerals list update. That matters not because a list magically changes reality, but because it signals how governments are starting to frame the supply chain. When a metal is treated as strategic, the priority becomes security of supply, not efficient pricing. Now add the overseas component. There have been escalating policy moves around key materials, and supply chain concentration is a real risk theme right now. You don't need to take my word for it. Just look at what's happening across renewables and electrification. Solar has been expanding at a pace that keeps surprising even the optimists, and that expansion pulls on silver in real manufacturing terms, not in meme terms. And here's the uncomfortable truth. When demand is structural and supply is stubborn, price doesn't mean revert because it feels high. Price keeps going until something breaks. So what breaks first? This is where people argue about substitution. They'll say they'll just replace silver. And sure, engineers can replace anything if the budget is unlimited and the performance loss is acceptable. But in the real world, designs are built around materials. Substitution takes time, retooling, qualification, reliability testing, and sometimes a total redesign. And for some applications, you can't swap it out without losing efficiency, durability, or safety. And that's why I'm skeptical when someone dismisses this whole move as mania. If it were mania, the supply chain wouldn't be straining. Deliverable inventories wouldn't be a daily obsession. Industrial buyers wouldn't be paying up to secure flow. The discussion would be about sentiment, not settlement. Now let me challenge one key narrative straight on, because this is part of the originality and the truth. A lot of people are acting like retail demand is the engine of the move. I'm not denying retail matters, but I am saying it's being exaggerated as a convenient explanation. When big institutions and commentators want a simple story, they love retail mania. It lets them dismiss the move, mock the participants, and pretend the fundamentals don't exist. But watch the footprints. When you see massive volume trade and then the open interest barely changes, that's not a crowd building a fresh, massive directional position. That's churn. That's hedging. That's options-driven flow. That's market makers doing what market makers do. Which leads to the third thing, the misinformation loop. This is the part that makes me legitimately angry because it's not just confusing people, it's setting them up. Here's a perfect example of how the narrative machine works. You'll see a story go viral about some big index rebalance or a forced liquidation date, and suddenly everybody is convinced a specific day is doomsday. People start front-running the fear. They start dumping. They start shorting. Then the day arrives and nothing like the apocalypse happens. The market shrugs and the people who panicked are left holding the emotional bag. That's not an accident. That's how weak hands are manufactured. In commodity markets, the difference between a reference index and an actual forced seller is everything. Most people don't know the difference, so they get played by the headline. And the worst part is once they get played once, they assume the market is rigged against them instead of realizing they volunteered to be manipulated by a simple story. So when you hear everyone has to sell, ask the one question that cuts through the noise. Who exactly is forced, and where is the forced flow actually coming from? If you can't answer that, don't trade it. There's a whole corner of the internet right now telling people to short silver because it's obviously going to crash. They say it with confidence. They say it with smugness, and most of them don't even define the risk. They don't explain what happens if you're wrong. They don't explain how margin works when volatility spikes. They don't explain that the exchange can demand more collateral while you're already underwater. They don't explain that if you short into a physical squeeze, you can get steamrolled by the market structure, not just the chart. And the scariest part, a lot of the people pairing this are doing it because they've been trained by another market to believe every vertical move must collapse instantly. They think everything is a quick flip. They think every market behaves like a token. But metals don't care about your vibes. Metals care about manufacturing. Metals care about inventory. And when you combine a physical drawdown with a paper market that's stacked with leverage, you get a setup where volatility isn't the end of the story. Volatility is the mechanism that forces position changes. Now, I'm going to slow down for a second and make this practical. If you're a normal person and you're thinking, should I short this? I want you to answer two questions out loud. First, if the price goes against you, how much can you lose before you're forced out? Second, if you're forced out, who do you think is on the other side ready to buy your cover? Because here's what tends to happen. The crowd gets baited into shorting. Price spikes, stops trigger, shorts cover, price spikes more. Then the same crowd says, see, it's a blow off top. They short again, and the cycle repeats until the crowd's account balance can't take it. That's not trading, that's feeding a machine. And the machine's favorite snack is overconfident leverage. Now, I know some of you are thinking, okay, John, if this is so real, why aren't the big outlets explaining it clearly? Sometimes it's ignorance. People don't live in the plumbing, but sometimes it's incentives. If the story is complicated, it doesn't sell. If the story is simple, it spreads. Retail mania spreads. Short it because it's high spreads. The exchange will crush its spreads. And in that noise, the average person misses the real opportunity. Not a quick trade, but a hedge against the kind of monetary environment that turns stable portfolios into melting ice cubes. Now let's talk about the international price differences, because this is where reality taps you on the shoulder. In a true shortage, price isn't one number. Price fractures. The quote on your screen becomes less important than the bid for real metal where real buyers are. When you hear that one market is trading at a premium to another, that's not trivia. That's a message. It's a signal that the physical flow is constrained. And here's what makes this part spicy. When a premium persists even as the headline price rises, it suggests the gap is about access, not about speculation. That's when you start seeing odd behaviors, like metal leaving one vehicle during a rally, because the metal is being pulled for other needs, or because the plumbing of settlement is shifting. That's not retail panic, that's supply chain rerouting. And this is also why you can see something that looks backwards to casual observers. The price rises, yet one large silver-backed fund can see metal leave. People assume that means investors are bearish. Sometimes it's the opposite. Sometimes it means the metal is being pulled because the physical is more valuable in the supply chain than it is sitting behind a ticker symbol. Think about it like this. A share is a claim on a structure. A bar is a bar. In a tight market, the bar is king. So when someone tells you, don't worry, there's plenty of silver, look at the market cap, just smile. Market cap doesn't deliver a cathode. Market cap doesn't solder a circuit. Market cap doesn't keep a production line alive. Only metal does. And here's another question I want in the comments. Would you rather own a promise or something a factory can't run without? Now, I'm not going to sit here and promise you some clean price target like it's a video game level. Anyone who gives you a precise number with a precise date in a situation like this is selling you confidence, not clarity. What I can do is give you a framework and to put some scale on the imbalance. The broader discussion in the silver world has been about recurring deficits, years where demand outstrips supply, meaning inventories do the balancing act. Whether those deficits are big or small in a given year, the direction matters because once inventories get low enough, the market becomes fragile. Fragile markets don't need a huge catalyst to move. They only need a small surprise, a shipment delayed, a refinery maintenance issue, a policy change, a major buyer deciding to stock up instead of run lean, and suddenly the thing people thought was impossible becomes a normal week. So, if you're wondering why I keep talking about plumbing and inventories, it's because price is the smoke. Inventories are the fire. In a physical commodity, the price has one job: ration demand and pull supply forward. When there's not enough metal, price rises to force someone to back off. It rises until a buyer says, nope, not at this price. Or until a producer says, okay, now it's worth expanding. But because supply is slow and demand is tied to critical manufacturing, the rationing function can be brutal. It can overshoot, it can spike, it can whip back, and it can do all of that while still being in a long-term bull move. So if you're staring at a pullback and thinking, aha, the top, be careful. In squeezes, pullbacks are often just the market taking a breath while the stress moves from one part of the system to another. Here's a question for you, and I want you to actually answer it in the comments. Do you think the biggest risk right now is the price dropping or the metal becoming unavailable? Because those are two totally different problems. A price drop is a mark-to-market problem. Unavailability is an operational problem. Companies can survive mark-to-market. They can't survive production line stopping. And that's why industrial demand can become price insensitive at the margin. If a factory makes high-margin products and silver is a tiny fraction of unit cost, they'll pay up to keep the line running. That's how shortages feed on themselves. Now let's address the option circus because this is where people get fooled by volume. In modern markets, derivatives can drive the underlying in the short term because dealers hedge.